Welcome to this ValueBridge.net case study. This is the third on cross-border deals where we separate how much of a private equity return comes from factors a manager can control versus broader market forces like foreign exchange rates, market multiples, and addressable market changes. Again, here we have a limited partner in the US, a general partner based in Europe, and a portfolio company that operates in Spain. The prior case study showed two ways to precisely calculate how much value comes from various causes. This time we'll exchange a bit of accuracy for scalability and create a market return matrix like this, which estimates the multiple of invested capital driven by the market for any entry date and exit date. So if a holding period starts in 2016 and ends in 2021, the market would drive a multiple of invested capital of 1.282, and the GP should only get credit for value creation over and above this benchmark. However, if a holding period starts in 2018 and ends in 2022, the market would drive a loss, illustrated by a multiple that's less than 1, so the GP actually creates more value than would be indicated by the return in the fund's quarterly report. In this video, we'll show you how to quickly separate the market versus manager return for a whole portfolio of deals and then convert these multiples into IRRs. Okay, first we need the market data. Foreign exchange rates are accessible on the web. For this example, we use the EUR-USD quote, which is the amount of USD that's exchanged for each euro. I pull down the monthly rates and take the average of 12 values to provide a blended annual rate for each year. You can make this more precise if you wish, but this is a good starting point. The FX return multiplier is the rate at time 2 divided by the value at time 1. So we can create a foreign exchange return matrix like this that describes the impact of the various entry and exit dates. For the broader market multiples, I'll use values from this R.W. Baird Global M&A Quarterly. It is an excellent publication that provides tables of data like this with European middle market enterprise valuation to EBITDA multiples. You can get access by signing up on their website, and there's dozens of different alternatives from other investment banks and industry data providers like PitchBook. The market multiple expansion multiplier is the multiple at time 2 divided by the value at time 1, so we can create a market multiple expansion return matrix like this. Lastly, for the company's addressable market, we'll use the GDP of Spain. That's probably not the best proxy for most deals, but this is meant to be illustrative. You should know the metrics that are most relevant for your industries, and there are countless available options provided by economists and industry research firms. The addressable market growth multiplier is the addressable market at time 2 divided by the value at time 1, so we can create an addressable market growth return matrix like this. Now, we can organize all of these market metrics into 3 columns and use them to build a total market-driven return matrix. Between time 1 and time 2, the market-driven return multiple is equal to FX2 times MM2 times AM2 divided by FX1 times MM1 times AM1. And that formula lets us build the following, which quickly shows us the return that we should expect for various combinations of entry dates and exit dates. Alright, now what can we do with this? Well, in the last 2 case studies, we had a deal that was held from 2018 to 2022. It had a gross multiple of invested capital of 2.833 and a gross IRR of 32.2%. This multiple is in euro, so we need to convert it to the LP's currency of USD. From the prior table, we know that the foreign exchange multiplier from 2018 to 2022 is 0.892. This means the FX rate decreased by 10.8%. Multiplying these numbers gives us a multiple of invested capital in the LP's currency of USD, which at 2.527 is lower due to the strengthening dollar. From the table on the right, we see that the deal has a market-driven multiple of invested capital of 0.973, which means the GP is investing against broader market headwinds. The manager-driven multiple of invested capital, then, is equal to 2.527 over 0.973, which gives us the same measurement of GP value add that we saw last time, 2.599. Now, we could convert all these multiples into internal rates of return. We see that the deal was held for exactly 4 years, but we know that it had an add-on acquisition after the initial platform investment and an equity distribution prior to the ultimate exit. So we need the effective holding period, which is the natural log of a deal's gross multiple of invested capital divided by the natural log of 1 plus the gross IRR. In this case, that's 3.731 years. The effective hold is a dollar-weighted duration that accounts for all the inflows and outflows that take place during ownership. And you can use it to calculate IRR with a compounded annual growth rate or CAGR formula. So the deal's IRR in the fund's currency is 32.2%. The annualized foreign exchange impact is minus 3.02%. The deal's IRR in the LP's currency is therefore lower at 28.21%. The annualized combined impact of foreign exchange rate, market valuation, and addressable market changes is minus 0.74%. So the GP's value add, or manager-driven IRR, is 29.17%. Now, these are estimates, but they're very good ones. Results from the last case study are more accurate because we actually used foreign exchange rates on the days in which the initial investment, the add-on acquisition, the equity distribution, and the exit occur. But even though we simplify that data in the market return matrix, the multiples and the IRRs are nearly identical. The results are also close to the derivative model approach that we used 2 case studies ago, and that required about 10 times the data to get these answers. In fact, all these results really only come from 8 numbers: the deal's gross multiple and gross IRR, and the 6 market data points on the right. Okay, with that, let's scale this model to analyze a whole portfolio of deals. Here we have 8 companies that we assume are all subject to the market dynamics that we outlined earlier. We start with the gross multiples in the fund's currency of euro, and then we add the foreign exchange multipliers based on the various entry dates and exit dates. The values above 1 enhance the LP's return, and those below 1 reduce the LP's return. They give us the following multiples of invested capital in the LP's currency of USD. From that market-driven return matrix, we get the following market-driven multiples of invested capital for each deal. And the LP's multiples over the market multiples give us the manager-driven multiples of invested capital. Each of these deals has a unique effective hold that can be calculated from the multiple in the IRR in the table above, as follows. And this lets us turn all these multiples into various IRR measurements for every deal. Some of them tell interesting stories. For example, Gulfco has an excellent IRR due to the short holding period. But thanks to favorable foreign exchange rates, the LP's IRR is even higher, at 62%. Now, despite favorable FX, the market return is overall quite negative because they sold in 2020 in the midst of COVID. That means that the manager-driven IRR is even higher at about 75%. Right below this is Hotelco, which so far has lost about minus 11% per annum in the fund's currency. A strengthening dollar means that the LP is actually losing about 14% per annum in USD. And when you factor in improving valuation multiples and addressable market growth, the manager-driven loss is even worse, about minus 17% per year. So that is how you could use a market return matrix to quickly evaluate an entire portfolio of deals. I hope that you found this helpful. Make sure to check out the Excel template on the case study page at valuebridge.net, and feel free to reach out to me if you have any questions. Thanks for watching, and see you next time.